we start. Welcome back from yesterday, where we talked about a general introduction into financial accounting in general, and then some points on IFRS, what the international financial reporting standards are, where they come from, what they are composed of, and where they are applied more or less in the world. And then we ended yesterday's sessions with this slide here showing us the content of regular IFRS financial statements. So that includes a balance sheet, an income statement, cash flow statement, statement of changes in shareholders' equity, and notes. Other parts of the report are not regulated as of today in IFRS. So maybe let's have a look at the financial statements of Air France. They are on your platform on Canvas. So you have this document. So first of all, we see here that for Air France, the financial statements are called Universal Registration Document. So that's a French name, applies only in France. And in France, the Universal Registration Document actually is a document that includes, as it says here, the annual financial report, so the financial statements. But in addition, we have some other information that is not necessarily financial, such as the legal situation of the company and so on. So the Universal Registration Document is a document that is recommended in France for listed companies. Okay, so it's not mandatory. And roughly 50% of the French listed companies, they prepare this Universal Registration Document. The other 50% do not. They just present the annual financial report. Okay, so let's see quickly what the content is. Actually, the registration document has the advantage that the chapters are rather standardized, more or less. And we see that everywhere where it says AFR, actually that's part of the official financial report of the financial statements. So we have a presentation of the Air France Group. We have something on corporate governance that obviously is very important today. Chapter 3 is on risk and risk management activities to understand how it is organized, who does what, and so on, and what are the main risks to which Air France is exposed. Then we have a CSR report on non-financial or extra-financial information and a performance statement. As I said yesterday, the CSR report here, although Air France does use IFRS, the CSR report is not part of the IFRS regulation. So the CSR report we see here from Air France is based on French, or should I say European legislation. So it's not an IFRS statement. It's European or French. And then in number 5, we have the financial statement, actually, with the consolidated financial statements of the Air France Group. Okay, some other chapters. And then in number 6, we have some other information, general legislation, legally, etc., etc. Okay, so in the Universal Registration Document, as I said, the content is rather standardized. It makes it easier to find the information and to compare at least French companies. Obviously, a non-French company would not do this. What's also interesting is to look at the first pages a little bit, because usually here that's where in the beginning the companies present what they call selected financial information. We could also say that's key performance indicators that they use, and gives us an idea what for this company and for this industry, because KPIs can be industry specific, what are important financial information. So we see here obviously sales revenue is very important. And we could even say that sales revenue probably is the most important accounting information that we have. And you see here, because of COVID, obviously it's an airline company here, because of COVID, 2020 sales revenue has strongly dropped. Then we have profit from current operations, and I explain later today a little bit what that means. So we could say it's like an operating profit. And we see also in 2020 it was strongly negative. Well, same because of COVID. Then a revenue breakdown depending on different activities. We will see that later. On the next part, we have net income or net result. So you see a lot of profitability figures, sales revenue, operating profit, net income or net profit are presented. And then here we have some cash flow information number, an adjusted operating free cash flow. And a little bit later today, we'll talk about the cash flow statement and I will explain those different notions. And then something about the debt level. Okay, so solvency of companies obviously is important and they present as net debt. And then another performance indicator, which is return on capital employed, is presented. And finally, a debt ratio. Debt ratio here defined as net debt divided by EBITDA. So tells us something about the capacity of a company to reimburse its debt. For 2020, the number is not given. Why not? Well, because EBITDA is negative in 2020. Therefore, it doesn't make really sense to present this number. Okay, so that's always a good idea to look at the first pages in a financial report, because that's where the management presents some key numbers, and the key numbers already tell you a little bit what the focus is of the company and of the industry. Okay, and then we have, as I said, chapter 5. These are the financial statements as such. And the point that is interesting to us here is the consolidated financial statements on page 246. So here we're talking about the financial statements of the Air France Group. Okay, do you have any questions so far on this financial report, or maybe on other reports that you have already seen in your academic or professional life? Any questions so far? Okay, apparently not. Then let's continue and go a little bit more into the details of IFRS financial statements. Okay, so first we talk about the balance sheet. Okay, so as you may remember, the balance sheet shows the financial position of a company at a given date, and the balance sheet date, which usually is December 31st. And in IFRS, actually, there is a rather high degree of freedom of how companies present their balance sheet. So IAS number 1 lists the requirements regarding the balance sheet, and actually there are not many requirements. Basically, the only requirement is that in the balance sheet you need to present 5 different blocks. So here we have 4 of those blocks: current assets, non-current assets, current liabilities, and non-current liabilities. So those 4 blocks must appear, and the 5th block is also to be shown. Which block is missing? Which balance sheet item here is missing in this list? And that would be the block number 5, equity. Indeed, that's correct, Dongpang. So equity now would be the 5th block. Okay, so in IFRS, the only requirement is show the 5 blocks. How do we distinguish in IFRS current assets and current liabilities from non-current assets and non-current liabilities? Well, usually we apply the 1-year rule. So anything that the company will use or pay within 1 year is current, so current assets or current liability. Everything that the company will use for a period that is longer than 1 year will be non-current. So for example, you buy inventory. Well, inventory is supposed to turn over rather quickly. Therefore, inventory is a current asset. You buy a machine that you will use over 10 years. Well, that means machines are non-current assets. Same thing for the liabilities. You take on a 6-month bank loan, it will be a current liability. You do a 10-year bank loan, well, it would be a non-current liability. However, for example, if you think about the 10-year bank loan, maybe you have to split the loan into 2 portions, a non-current portion and a current portion. Because if you take on a 10-year bank loan, but the loan tells you that every year you have to reimburse, well, that means obviously I will reimburse part of the loan in the next year, and that part would be a current liability. And only the remaining part of the loan has a maturity that is longer than 1 year and would be non-current. So 1 year would be in the current section of the balance sheet, and the remainder of the loan would be in the non-current section. So that's also possible, and every year, obviously, I would need to adjust the numbers as we move on in our loan situation. Okay, so let's have a look here at the balance sheet of Air France as it is shown in the annual report that you have also. So we see here the non-current assets as the first block. Okay, we have the current assets as the second block down here. On the following page, we show total equity, so block number 3. We show non-current liabilities, block number 4. And we show current liabilities as block number 5. Okay, so we see here Air France does use IFRS and the balance sheet is conform to the requirements as they present the 5 blocks, and therefore we are good. Now, what you present inside each block, so here, for example, for the non-current assets or for the current assets, that is up to each company. So IFRS does not require anything particularly. Obviously, remember we have the principle of relevance. Everything that is relevant should be shown. Well, in terms of balance sheet presentation, we could say that all items that are big in amount or that are very important for the business probably should be presented separately. But again, it's not specifically written in IFRS, it's only deducted. So we see here what IFRS or Air France here in our case does. They have goodwill, intangible assets. We see that the biggest asset portion is flight equipment, which obviously makes sense. It's an airline company, so the most important assets probably are aircraft. But we see also that Air France has some smaller items here presented on the balance sheet, such as derivatives or other non-current assets, only 4 million euros. Okay, why do they present this line separately? Frankly, I don't know. They could also have regrouped different smaller line items and just all of them call them other. But they decided to split them up in this way. Okay, here we have a continental European balance sheet, and therefore the first block presented will always be non-current assets and the second block will be current assets. In the Anglo-Saxon world, in particular in the US, if you look at the US balance sheet, potentially the order might be inversed. So current assets first, non-current assets second. Okay, it doesn't really change anything. It just shows you that accounting regulation and uses are different. Okay, inside the non-current assets, we have 3 subcategory of non-current assets. Okay, so we have the first subcategory that we can subsume or regroup as intangible assets. So goodwill is an intangible asset, and there are also other intangible assets in the Air France group. So intangible assets are assets that are owned by the company that are long-term because they are non-current, okay, and they are not tangible in nature. So we're not talking about physical equipment or something like this. We are not talking about financial items neither, because for financial assets we have a different category. So what could be intangible assets? Do you have examples of intangible assets? And as I said, goodwill is one of those. Maybe someone can tell us also what goodwill is. So what are intangible assets in general as examples, and what is goodwill in particular, if someone knows? Anyone? An intangible asset, so something that is not financial in nature, something that does not have physical substance, but that companies do use over more than 1 year in the long term. What do we have? Dongpan, yes, very good. Patents, copyright, franchises, trademarks, trade names, all this is correct. Goodwill. We could add, well, wait for another post. So software would be another item, for example, intangible. And what do you think for an airline company? Yes, we do. So I talk about goodwill a little bit later. So what do you think about an airline company? What is a very important intangible asset that airlines need and without which they would not be able to operate? So it's not only important in terms of having your, having your business, but without it, actually, you could not work. The airline would not be able to work at all. What do you think? What type of intangible asset that could be? Customer data. Well, customer data is important. I agree with that, but it's not necessary to operate a flight. Okay, so then we have the solutions here: permits or the right to operate the flight, which means more precisely the license and the landing slots, obviously airport slots. No? So without airport slots, well, you cannot land. If you cannot land, I'm not sure that many people want to go with you in your plane. No? Because getting off is one thing, landing is a different story. No? Okay, so landing rights, slots is very important. No? And that would be part of intangible assets, but also all the other elements that you mentioned, brand name, software, and so on. And we had also comment on goodwill, what goodwill is. And indeed, as Thuy Do indicated, goodwill happens when Air France acquires other companies. So we'll see that a little bit later when we talk about consolidation. And goodwill is an amount of money that you pay beyond actually the value of assets and liabilities that you buy when you take over another company. And we'll see a little bit later more in detail. But anyway, so the first block in our non-current assets are intangible assets. Then we have the second block. We could say the next 3 lines here are part of the second block. And here we talk about tangible assets, fixed assets, tangible assets, or in general, sometimes also called property, plant, and equipment as a synonym. So PPE, property, plant, equipment, tangible assets would be the second block. That includes aircraft, of course, flight equipment, but also other property and equipment. So vehicles on the ground, for example, installations, buildings that they use, etc., tools. All of this would be in other property, plant, and equipment. And we also have this third asset here that is called a right of use asset. Has some of you heard of this item? And maybe you know what it means? What is a right of use asset? Also abbreviated as ROU, obviously. Right of use. Any idea? Well, maybe not. It's not a problem. Actually, right of use assets here, we are talking about leased assets, rented assets. Okay, so Air France and other airlines, for example, they do rent a lot of aircraft. And the rented aircraft actually is represented on the balance sheet as right of use assets. So probably the major part, well, we can check in note number 19 if we want to, but the major part of those 4 billion, 4.6, 4.7 billion of right of use assets are flight equipment and aircraft. So leased assets are represented in the balance sheet of the renter, not the owner, in the balance sheet of the renter. And they are represented as right of use asset. This is an example of the principle that I mentioned yesterday, the principle of faithful representation, or the principle of substance over form. Economic substance more important than the legal form. And here leasing is a very good example for this, an illustration, because what matters here is to know which are the assets that the airline uses, because Air France generates a sales revenue. And for example, I would like to know how many aircraft do they use in order to generate that sales revenue. Well, from that point of view, it doesn't make a difference if the aircraft that you fly around is owned by you directly as in flight equipment, or if the aircraft is only rented. It doesn't matter. Your clients do not care. They don't even know. They just take Vietnam Airlines. They don't know if the aircraft is rented or is purchased and owned by Vietnam Airlines. So therefore, economically, I want to know all the assets that the company uses. I do not necessarily care, at least not for this analysis here, if the company owns legally the assets or not. And that's why all leased assets, with some exception, in particular for short-term leases, for example, less than 1 year, all more than 1 year leases actually appear on the balance sheet as so-called right of use assets. Okay, so first block, usually intangible assets. Second block, tangible assets. And the third block here in the non-current section is, we could say, or are all financial non-current assets. So in terms of terminology, usually when you use the term intangible assets, it is not necessary to add non-current, because by definition, mostly intangible assets are only non-current. Same thing for tangible assets. Tangible assets by definition are non-current, so you don't need to add this. For financial assets, here the third part, on the other hand, it's different, because financial assets can be long-term or short-term. That means here I need to specify if I talk about financial non-current assets or if I talk about financial current assets. So here the third block is financial non-current assets. As I said before, why do they have so many lines for this? I don't really know. It's not mandatory, but actually it has always been this way. So for decades now, they present the balance sheet this way, and that's why they are not changing. And we see what the financial assets here involve, investments in equity associates, and we will see later what that means. Some pension assets, we'll see later. Derivative financial instruments here, long-term, are included, etc., etc. But we see obviously that the financial part of the balance sheet here in the non-current section is not so important. It's more important, obviously, the tangible assets. Okay, so in the non-current section, intangible assets, tangible assets, and financial. In the current section, same thing, no requirements in IFRS what you show, but all companies obviously show some inventory all companies show some trade receivables, and all companies show cash and cash equivalents. Okay, these are the main items or the most interesting items that I have on the asset side of the balance sheet. Question so far on the asset side here of Air France? Well, then we switch over to the equity and liability side. So here, the same story. Well, no requirements beyond showing our three blocks that we have here: equity, non-current liabilities, and current liabilities. Same thing in Europe, continental Europe, you usually start with equity. In the US balance sheet, the balance sheet would be upside down, and you would start with current liabilities actually as the first number. No? So I'm not discussing here different items. Same thing, it's an Air France structure. So they decided to present those individual lines. Most of the lines, we'll see them later when we talk about accounting for equity, accounting for provisions, some financial debt accounting, and so on. As I said before, leased assets are on the asset side of the balance sheet as right of use asset. And I see also on the liability side of the balance sheet the corresponding lease debt, because when I rent an asset, I commit the company to pay or to make lease payments over the next years, and therefore I need to show lease liabilities in the balance sheet. Okay, so that's the Air France balance sheet. All good for IFRS. Now let's see another airline, EasyJet, which is a UK airline, a low-cost airline, and they also use IFRS. Okay, and therefore we check, well, they have non-current assets, they have current assets, they have current liabilities, they have non-current liabilities, and they have equity. Okay, so we see our 5 blocks, and therefore, well, no problem. We see that EasyJet is in line with IFRS requirements. Then once again, we see that the individual line items maybe are not the same, and we'll see talk about this a little bit later. But we see also that they present all this in a very strange way. When I say strange, if I compare to Air France, for example, Air France lists all the assets, and then we show total assets in the balance sheet. Okay, and then Air France lists all equity and liabilities, and we can end the balance sheet with total equity and total liabilities. Okay, but we see here for EasyJet, we don't have that. For example, they do not present total assets. They do not present total equity and liabilities. They're not presenting this. And in addition, we see here that liabilities, here's one liability block, here is another liability block. They are presented as number in brackets, which means negative numbers. So here actually liabilities are deducted. And they calculate and present on the balance sheet something that is called net current assets or current liabilities, which is current assets, 4.1 billion, minus current liabilities, 2.6, 2.7 billion, equals net current assets of 1.5 billion. So they're even deducting things on the balance sheet. And then they're deducting also non-current liabilities to calculate something that they call net assets. You see, net assets. Well, an item we don't see in the Air France balance sheet. And we see net assets is 2.6 billion here. Okay, and we see also that this amount corresponds to total equity, which is also 2.6 billion. Okay, so a rather strange way of presenting. Okay, because you have negative numbers. Liabilities are negative, they are deducted. There is something as called net assets, which apparently is the same as equity, but why do they present it then? And they have here this item of net current assets, which is also very weird. Okay, so my question is, why do they do this, and why do they present the balance sheet in this way? And maybe to better understand this, a more detailed question is, what is net current assets? That is a notion that maybe you have met already in your finance courses, and maybe with another name than net current assets. Does anyone know? So net current assets is calculated as current assets minus current liabilities. Any idea what that actually means in finance? Okay, some people are writing. Net current assets represents the capital available to fund short-term capital needs of the firm. Yes. And we know this concept as working capital, indeed. So here the net current assets is what we would call working capital, or sometimes working capital requirement, either way. So it means here actually EasyJet is presenting an indicator, an information on the balance sheet that usually analysts would calculate themselves. Obviously, it doesn't make a big difference. I can calculate this on my own. It would take me like 25 seconds, roughly. So the point is not so much to make the life of analysts easier, because anyway, most companies nowadays, as you may know, actually give you the financial statement numbers directly in Excel format, so that analysts can import the Excel file directly in their own Excel file with the application of all the formulas and so on. So that's really not the point here. Why do they present this? Well, the point is more to it's part of financial communication, and it sends the message to people in the market that EasyJet wants to be shareholder friendly, wants to be investor friendly, analyst friendly. And since I give you the working capital directly on the balance sheet, that means also we internally, the management internally, also looks at working capital, and checks out what's going on, etc. So that means we are working for shareholders, in a sense. That's the message here. And the similar message here is for net assets. So in the end, how did they calculate net assets? Well, they took non-current assets, that's the first part, okay, plus current assets, that's the second part, okay, minus current liabilities. And remember, current assets minus current liabilities is presented as working capital or net current assets. And then they deduct non-current liabilities. And that's how they calculate here net assets, which means, in other words, net assets is total assets, because I have non-current assets and current assets, minus total liabilities, because I deduct short-term and long-term liabilities. So net assets is assets minus liabilities. And if you look in the balance sheet, well, assets minus liabilities is equal to equity. So it means net assets is a synonym for equity. And a synonym that is widely used or often used by analysts, the same thing. So it means here I use the language and the terminology of analysts, not necessarily directly the language of accountants. Accountants also use net assets, of course, but in the balance sheet, I would call this equity, not net assets. Net assets is when you start valuing a company and so on. So here they present net assets. And actually, from an analytical point of view, that's equity, and only the total amount of equity is interesting to me. Whereas here, this final information, how the 2.7 billion in net assets are composed, share capital, share premium, and other items, that is not interesting from an analytical point of view. There is no ratio or no analytical approach where you individualize items within equity. The only calculations that you do usually is you take total equity, total net assets to do your valuations. So it means here by presenting net assets, once again, they say, okay, we are presenting this in a way that speaks to analysts, because we care about analysts, we care about shareholders, we care about investors. And that's the message here by this presentation. And they present the details of equity down here only because that is a requirement in IFRS. So IFRS requires that either on the balance sheet, and most companies do it, or in the notes somewhere, I need some details about equity. And that's why they present those details. But economically speaking, they are not really interesting. They are not really necessary. Okay, so far for this presentation. Now, I want to give you 5 minutes and compare the balance sheets of Air France and the balance sheet of EasyJet, and indicate 3 differences or 3 common points. Okay, can you do that, please? So 3 items that are identical and 3 things that are different between the 2 balance sheets. Well, except the differences that we discussed already here. So I'm more talking about the individual line items. Okay, so please take 5 minutes, compare the 2 balance sheets, and tell me what do you see as differences and what do you see as common points. Please do that. Okay, so maybe some of you could write some differences or common points. I don't know, let's start with the common points. Do you have 1, 2, 3 items that are common for both companies? And can you please tell us which ones? Someone? No? No one? Please, someone? Common point or difference in the financial statements between EasyJet and Air France? Would be nice if you could participate a little bit. Other than that, I will talk to myself the whole time. Okay. Okay, An Huang, that's correct. Non-current assets and all this the same, but I was more talking about individual line items, not the 5 blocks. Obviously, the 5 blocks, we will see them because that's required in IFRS. So both companies and all companies in IFRS show us the 5 blocks. But it's more like individual line items. So for example, here we have goodwill. Goodwill is presented by both companies. We have also in common derivative financial instruments, for example, in the non-current section, but also in the current section. We have a common line item of cash and cash equivalents, for example. We have lease liabilities in the current section, and we have lease liabilities in the long-term section. Okay, so these are common items. Okay, do we have some differences? Yes, very good. Dongfan. Okay, very nice. And now do we have some differences? So they have restricted cash, money market deposits. That's something that Air France does not have. So restricted cash usually are deposits also when you have a rental contract or a lease contract. Actually, you need to make a safety deposit for the future rent, for example. We also have, as indicated by Dongfang, some differences here in equity in terms of hedging reserve, cost of hedging reserve, translation reserve. These items are not presented in Air France. They have different items. Okay, well, because each company can make this on its own. What are those reserves? Well, we'll see that a little bit later when we talk about the hedge accounting. Then we'll talk about the hedging reserve. And when we talk about consolidation, we'll also see what the translation reserve is. So here maybe just a short explanation. Translation reserve relates to the fact that I need to currency translate financial statements of subsidiaries, because here we are in a group setting. That means I have subsidiaries in different currency zones. All those currencies need to be converted into British pounds because EasyJet has British pounds as currency. And when I do this, there are translation differences and they are put in equity. They call this translation reserve. Maybe an interesting difference is, remember we talked about the right of use assets, leasing and so on. We see that EasyJet does not show a right of use asset. Does that mean they don't lease contracts? Well, no, because here we see lease liabilities on the first hand, and secondly, all companies use leasing contracts. So why don't they show a ROU asset? Well, actually, because they integrate this in property, plant, and equipment. That means Air France separates owned PPE and right of use assets. EasyJet, they all mix together. And then we can check in the notes, note number 11, they will give us the details. And in the notes, they will tell us what is owned legally and what is only rented. So we get the same information, but not presented in the way it is. No? Yes, very good, Dongfang. Still some other differences that we have. And you see, therefore, sometimes it can be not really difficult, but tricky to compare two balance sheets, because to see, you need to see then which line corresponds to which line in the other balance sheet. Okay, so here you have a question on perpetual, on non-controlling interest, and additional paid-in capital. So we will see this later. So non-controlling interest, I will explain to you when we talk about consolidation. Okay, and additional paid-in capital and perpetual, I will explain to you what that is when we talk about accounting for equity. Okay, so I will not answer that now. I will answer this later and we'll come back to those line items. All right. Okay, then I propose now that we do the dinner break for you. Okay, that means I will stop the recording and we will meet again, let's say at 8:25. Okay, good. Welcome back. Here we are again. So we saw the presentation of the balance sheet. And now we will continue. So maybe one element, I will give a participation bonus for people that participate in this class. So via the chat or asking questions, answering questions. So if you participate regularly, you will get a bonus on your grade. Okay, now let's continue and talk about the income statement. So first element here is, in the income statement, we saw this yesterday, we present revenues and expenses, and the difference between revenues and expenses then is profit. But in IFRS, actually, the notion of profit and the notion of income statement is enlarged. And you can see this already by looking at the name, because in IFRS, it's not really called income statement, it's called statement of comprehensive income. And that means we have in IFRS the traditional income statement where we have revenues and expenses, but we also have something else. We have what is called OCI, other comprehensive income. So the total profit in IFRS is composed of traditional profit out of the income statement, but then we add or we subtract other comprehensive income, which can be positive or negative. So that means here we have the traditional income statement, revenues and expenses, and we have OCI. Okay, so let me first we go back to this 1 or 2 slides on OCI. What is other comprehensive income? Well, here we talk about gains and losses that are not accounted for in the income statement. So usually gains and losses, revenues and expenses are put in the income statement. But here we account for gains and losses. And as a counterpart, remember double entry bookkeeping. If I have an accounting entry somewhere, I need it twice. Well, the gain and the loss will be recognized directly in equity, the second part, not in the income statement. And the item in equity is what we call OCI, other comprehensive income. Examples, well, gains and losses based on fair value accounting of certain financial instruments. And the idea is that on the one hand, somewhere I want to see all the profits that the company made. Okay. On the other hand, maybe I don't want all those profits and losses in the income statement. Why not? Well, because the profit in income statements has consequences for dividend payments. Because as I said yesterday, usually my accounting profit, the accounting profit in the income statement, is the basis for dividend payments. So therefore, I don't want to have all gains and loss in the income statement because they will result in additional dividend payments. And also, there may be a link between the accounting profit in the income statement and taxes, income taxes, profit taxes. And here's the same thing. Maybe I don't want to have taxes on all gains and losses. Okay, let's see why not. Why do I need to use, or why did IFRS choose to use other comprehensive income? It's a concept that exists in Anglo-Saxon accounting, so US accounting, US GAAP would be the same. UK GAAP, you have something similar. But for example, in European accounting, we don't use OCI. So example, the company buys an asset for 100. At the end of the year, we have 2 scenarios. In the first scenario, the value of the asset decreased down to 80. And in the second scenario, the value of the asset increased up to 110. So I buy for 100, then either decrease down to 80 or increase up to 110. Okay, so how do we account for this? So here, let's say traditional accounting, and here accounting with using OCI. So first traditional accounting, okay, I buy the asset for 100. Therefore, it appears in my balance sheet at that price. And then the first scenario, the value of the asset decreases down to 80. Okay, so therefore, I will account for a value decrease of 20, bringing the book value of my asset down to 80. And that means I had a loss on my asset, and this loss goes in the income statement. Okay, so nothing fancy here. Second scenario, the value of my asset increases up to 110. So hypothetically, therefore, I could increase the value of my asset up by 10 to 110. And obviously the plus 10 is a gain, and the gain potentially could be put in the income statement. Okay, so that would be regular accounting. Now in real life, actually, in the situation A, we do indeed account for a loss, and we'd call this an impairment loss, for example. But in the B case, in traditional accounting, we do not account for this gain. So the gain of 10 usually does not appear in the income statement. So we don't do this. And if I don't want to have the gain of 10 in the income statement, well, I cannot account for the value increase on the asset side. So basically, when I buy an asset and the value of this asset, the fair value increases, what do I account for? Well, nothing. I do not account for the value increase in the balance sheet. Therefore, I do not recognize the gain in the income statement. So why don't I account for those 10? Well, the main reason is that I don't want to see the gain here in the income statement. Why not? Well, because this gain here increases profits, of course. If profits increase, there will be higher dividend payments. And if profits increase, there is the risk, the danger, the possibility of higher tax payments. And I don't want to pay dividends and I don't want to pay taxes on this gain of 10. And why not? Well, because this gain is only on paper. As you see here, the value of the asset increases at the end of the year, but I'm not selling the asset. I didn't sell it. It's only what we call a paper gain. It's a gain on paper. It's not a gain that has been realized with a transaction. And that is one of the fundamental accounting principles. So it's also known as the principle of prudence or the principle of conservatism. And it means that, well, we account for profits only and gains and revenues in the income statement only when they are realized. And that means they are based on a transaction. So here we do this for profits. Okay, we don't do this for losses. So here in the A case, it's only a paper loss. Same thing, we didn't sell the asset, so the loss here is only on paper. But paper losses, they have to go in the income statement, whereas paper gains are not allowed to be put in the income statement. Okay, so that's why in traditional accounting, in case of value increases, I don't account for them. All right. But that means now in the B case, if I don't do nothing, that gives me not relevant information and it's not a faithful presentation of the reality. Remember, faithful presentation is one of the fundamental principles in IFRS. Why is the B case, when I account for nothing, not a real representation? Well, first of all, because in the balance sheet, I would still show an asset with a value of 100, although I know that the real value of the asset is 110. So I show the wrong asset value in the balance sheet. And in the income statement or somewhere else, I don't show a gain, although objectively we did make a good investment decision because I bought the asset for 100. At the end of the year, the value has increased. So that means I made a good investment decision. Where can I see this good decision? Well, nowhere, because in the B case, I'm not accounting for anything. So that means I don't see the real value of the asset in the balance sheet. I don't see the real performance of my decisions. Therefore, this is maybe not a good idea to account for nothing in the B case. That's where OCI kicks in. Because now what I can do is, in both cases, when there's a loss of value, I can put that, I mean, that's hypothetical, it's a theoretical slide here, it's not IFRS, but hypothetically, I could put the loss directly in equity, okay, or I could put the gain directly in equity. That's what we do in OCI. So why in equity? Why is OCI part of equity? Well, remember yesterday when we did our accounting entries, we said that the accounting profit actually is part of equity. So here I take my profit out of the income statement, and this the income statement is only a sub-statement to show me what's happening in profit, but profit is part of equity. So it means here, instead of putting gains and losses in the income statement and then via the profit they go in equity, I put them directly in equity. And I create a new item that I call OCI. And in OCI, well, I put the gains and losses directly. Okay, so therefore, OCI is part of equity, same as profit is part of equity, but the difference is that OCI is not in the income statement and therefore has no dividend consequences and has no tax, well, probably has no tax consequences. Obviously, the tax consequences depend on the tax laws, not on the accounting laws. Okay, so therefore here, that's the IFRS idea. Is okay, certain gains and losses, I don't put them in the income statement because of those dividend and tax consequences. I put them in OCI. And this has two advantages. First of all, I see the real asset values now in the balance sheet. Either they decrease, they increase, doesn't matter. I see them. And by looking at OCI, in addition to the traditional income statement, I also see the total performance of the company, because I see that in the situation A, we made a bad investment decision. In the situation B, we made a good investment decision. Well, I see both good and bad is visible in the statements. Okay. So that is OCI. Okay, that means we have certain gains and losses that are not put in the income statement. They are put in equity directly in a line that is called other comprehensive income. So that means we have profit out of the income statement plus OCI equals what is called total comprehensive income, what we have on the previous slide. Okay, so sorry, I have to do this. So here I have the traditional profit out of the income statement with revenues and expenses, and it ends with profit or loss. Okay. Then I add OCI. Well, as I said before, can be plus or minus, so gains or losses. And I end up with total comprehensive income. Okay, so that's the total profit in IFRS. Okay, questions so far on OCI, please. Any questions so far? Okay. So question, is OCI internal only or is it external? No, it is external. Here we're talking about IFRS, so that means in the financial statements we will see OCI and we will see total comprehensive income. But obviously you are right. Many companies do use something like OCI internally, independently of IFRS. So especially for you people in the banking and finance industry, obviously, if you have a trader desk in a bank, you will look at gains and losses on a daily basis, and you don't care about paper gain or paper loss, etc. So all performance of traders is measured by looking at value changes day over day. So internally, banks do use OCI in a sense. If the accounting allows the reporting for this or not, doesn't really matter. But here we are IFRS, and therefore everything I'm telling you here is external. And therefore OCI will be published, as we'll see in a little while when we look at some excerpts. Okay. All right, so here's some things on the presentation of the statement of comprehensive income in IFRS. Okay, so the statement of comprehensive income can either be presented in a so-called single statement or in two statements. So what does that mean? Single statement means all of this here on one page, basically. That's a single statement. And two statements means, well, I split them. Since I have two parts, I present the two parts separately. That means I will present the traditional income statement on one page, and I will show profit and loss and OCI on a second page. And that's the distinction. So let's see this here by looking at the examples. Here, for example, I have Orange. Okay, and here I have Vodafone. And here we have a two-statement approach, because I have on one page the income statement, revenues minus expenses, and it ends with profit or loss of the financial year. Okay, and then on a second page, okay, I have a second table where I have again my profit and loss from the additional income statement, but I also have here all the OCI items, ending with OCI, okay, and then total profit plus OCI equals total comprehensive income, as you can see here. Okay, so Vodafone here, which is, well, you probably know, I don't know if you have Vodafone in Vietnam, but otherwise Vodafone is a UK telco operator. And they use the two-statement approach. So traditional income statement on one page, and then on a second page, the profit out of the traditional income statement plus OCI and total comprehensive income. So that's on two separate, that's the two-statement approach. And again, most companies use that. However, here's another example of a Swedish telecom operator, Telia Sonera. Okay, and they use the one-statement approach because everything is on one page. So here we see the profit out of the traditional income statement, which is here. And then we add OCI, which is here. And then we take the two together and I have total comprehensive income. So this would be the so-called single statement approach. Everything is on one page. Okay, as I said, most companies prefer the two-statement approach. Why? Well, because they prefer to still focus on traditional net income. And you know, traditional net income in the income statement is also called the bottom line. And here, if I look in the single statement of the bottom line, obviously I don't see the traditional profit. I see OCI. And that's not maybe what I want to see. I want to see this profit here. So therefore, most companies focus on the two-statement approach. That means I have a traditional income statement, and therefore I can use bottom line, which is the profit of the current year. Okay. So let's see. Can you check out for Air France in the report? Could you please check out if Air France uses the single approach or the two-statement approach for OCI? Can you please do this by checking in the report? So I give you a few minutes. Please check the comprehensive income statement for Air France, and therefore if they use single statement or double two-statement approach. Okay, Dongfan, you say they use two statements. And where did you see this? On which page? Can you tell us, please? Page 246 and 247. Let's go there. Well, indeed, 246, we have the income statement. And if I look at the income statement, indeed, it ends with net income, net profit of the period. And then on the following page, I have again the profit here, and then I have some other items, and they are all making up other comprehensive income. Okay. Well, here more or less total other comprehensive income, and then I have profit plus total comprehensive, other comprehensive income equals to total comprehensive income. So indeed, yes, that's correct. Air France uses the two-statement approach, like most other companies. Okay, now let's have a look only at the traditional income statement. Revenues minus expenses equals profit, what we have down here. You have the income statement of Orange, which is a French telecom operator. And you have the income statement of Vodafone, which is a UK operator. I give you a few minutes to see what you see in differences and common points between those two income statements. Okay, few minutes, write down 1, 2, 3 differences that you see between those two income statements. And well, 1, 2, 3 common points. Differences here are more important. Okay, differences between those two statements, please. Okay, so if you have something, please write it up in the chat. Common points or differences between those two income statements, between Orange and Vodafone. Anyone? Something? Yes, okay. That is true. Vodafone presents an income statement that we very often see for US companies. That means we have revenue, then we see gross profit as an intermediary profit, operating profit, profit before tax, and profit after tax. That's correct. Whereas here for Orange, well, we have no gross profit. We have operating profit. Okay, we don't see profit before tax, and it just goes on with profit after tax. Yeah. Orange, I'm not sure if it's UK because Vodafone is already UK. Vodafone is already UK. Okay. And obviously, once again, we have many differences in the details. Once again, in IFRS, like for the balance sheet, for the income statement, there is no mandatory format. So it means there's even more freedom regarding the income statement than you have in the balance sheet. You can do whatever you want. And very little information is actually required on the face of the income statement. And the information that is required are the lines that I showed on this slide, which means not much. You see revenues, okay, finance costs, some other items, but that's basically it. Okay. So there's a huge degree of freedom in terms of the income statement. In particular, companies have a choice to present their income statement by nature, okay, and that's what Orange does, or by function, and that's what Vodafone does. In an income statement by nature, what does that mean? Here we are talking about the way how expenses are presented in the operating section. Okay, so maybe before we discuss this, going back to a regular income statement, you see that usually in a regular income statement, we have, we could say, two layers. The first layer is the operating layer, where we have operating revenues and minus operating expenses. And obviously the result is operating profit. And that's the first layer. And then we have a second layer where we have financial revenues and financial expenses, mostly interest expenses, obviously, for our debt. And the result here is the financial profit. And usually the financial profit will be negative because we have far more interest expenses than we have financial revenues in a manufacturing company. Obviously, I'm not talking about a bank or an insurance company. Okay, so we have the operating block and we have the financial block. So regarding the operating expenses, so again, only the expenses that are in the upper part of the income statement, the expenses here, they can be classified by nature, Orange, or Vodafone by function. Okay, by nature, what does that mean? That means here in the operating section of the income statement, I see the type of expense that the company had. That means I see all the salaries, for example, labor expenses, are all the salaries paid in this company. I see raw materials that has been consumed. Obviously here Orange is a service company, not a producing company, but everything they sell, iPhones, equipment and so on, are purchased from the outside. They are purchased from Sony, from Apple and so on, and therefore have a specific line on external purchases. In order to provide the services, they need to use property, plant and equipment. And because they use those, well, property, plant and equipment loses in value and needs to be depreciated. And therefore, they have specific lines on depreciation, okay, in total. Okay, so it means in an income statement by nature, I see the different types of operating expense that the company had. Salaries, raw materials, depreciation for equipment, and something else maybe. Okay, that's an income statement by nature. Okay, in an income statement by function, that is what Vodafone is using, I don't see those items. You see here, I don't have a line salary expense. I don't have a line depreciation. I don't have a line raw material or external purchase, etc. Why not? Well, because in an income statement by function, all those types of expenses are allocated to functions in the company who generated those expenses. Okay, so I'm looking which part of the company generated those expenses, and then I allocate them to this part. So, for example, a company does production. Here it's a service company, but they produce services. Therefore, they have production cost or expenses that are related for production. All those expenses are regrouped in cost of sales. That means here I have 30 billion pounds, British pounds, of cost of sales. That includes salaries of people working in production, material and purchases used in production, depreciation of equipment that is used in production. All those different types of expenses are regrouped in just one line, and it's called cost of sales. Then a second function is marketing, and therefore here I have this line selling and marketing or selling and distribution expenses. This amount here includes all salaries, depreciation, whatsoever operating expense that is related to sales and marketing. Okay. And number 3, I have an administrative function, and therefore all salaries and other operating expenses that relate to administrative functions are regrouped in one line called administrative expenses. So it means in an income statement by function, I usually have 3 lines: cost of sales for production, selling and marketing, administrative expenses. In some industries, in a functional presentation, they would add a 4th line. What could be a 4th function? Very important. That would be separated. For example, usually in the pharmaceutical industry, you have this 4th function. Or in car manufacturing, you will have this 4th function. What could that be? Another function than production, marketing, or administration that may be very important for the company, for the survival and long-term prospects of the company. What could that be? Any idea? Pharmaceutical industry, for example. No. Well, R&D could be the 4th function. So some companies show this, and therefore they have 4 lines. So cost of sales, selling and marketing, administration, R&D potentially could be a 4th line. So companies have a choice if they want to present their income statement by function, such as Vodafone, or by nature, such as Orange. Okay, that makes comparability obviously complicated because we don't have the same information at all. Okay. Very important, the intermediary results that you see here, operating income, for example, for Orange, or gross profit, operating profit for Vodafone, those intermediary results are not defined by IFRS. Okay, that's a company choice, and they can do whatever they want. So, for example, when we have a look at the income statement of Air France, okay, Air France, for example, presents EBITDA in its income statement, and then something else, income from current operations, and then income from operating activities, etc. All those items, or net income of consolidated companies, all those intermediate profits here by Air France are chosen by Air France. That is not at all mandatory in IFRS. Okay. So it means either I need to calculate this on my own if I want to do it, or at least I need to be aware that it's not mandatory and can be defined differently. So tell me here, by looking at the income statement of Air France, do they use an income statement by nature or an income statement by function? What do you think? Income statement by nature or income statement by function? Indeed, Dongfang, we have one answer. And the second one, Chungtran, yes. Indeed, very good. We have an income statement by nature, because I see total salaries, I see total depreciation, I see external expenses for things they need to buy from the outside, etc. So indeed, it's a presentation by nature. Okay, so far so good on the income statement presentation. Any questions up to now? so can be presented by nature or by function. Okay, maybe forget this one last point. So which companies choose the functional presentation, which companies choose the presentation by nature? So you saw that Air France uses a presentation by nature. Well, yes, because Air France is in the service industry. Usually companies of the service industry, they present the income statement by nature. That means consulting business, entertainment business, hotel business, airline business, transportation services, other than that, etc. Usually they will be by nature. Because, and that's an important point, okay, the financial statements here that I look at when I look at Air France are from last year. We are in 21. Well, right now we are already in 22. But here I look at the numbers from last year. Obviously, why do I look at the numbers from last year? It's not so much to know anything what happened in Air France last year, because last year is already over. I am an investor. Now I'm at the beginning of 22. I want to make an investment decision today. So I'm not so much interested in knowing what happened in the past. I'm more interested in trying to know what will be in the future, because my investment decision today and the success of this will depend on the future development of the company. So we look at the past, we look at the financial statements, but not to know the past. It's more to have a basis to do forecast, because actually the most important function of financial statements is the forecasting function. Okay? I look at the past in order to be able to make a forecast. And the better, the more accurate my forecast is, the better will be my investment decisions. And hopefully I can make money. And that means here, okay, I look at the past numbers because I want to do a forecast for 21 or 22. So for an airline company, if you want to forecast the profit of next year, what do you need to do? Well, you need to forecast the sales revenue. Okay, right now it's a little bit difficult with COVID restrictions for airlines, but you need to forecast the future sales revenue, and then you need to forecast the future expenses. And obviously for an airline, what do you think are the main expenses, the main cost drivers for an airline? So I need to forecast future revenues. I also need to forecast future expenses. And by forecasting the expenses, obviously, I will focus on the most important ones. What do you think are the important expenses for airlines? Any idea? Well, airlines is a service business. Therefore, they depend on people. Therefore, a very important item are salaries. Secondly, a very important cost item is fuel. Therefore, I need to know, or I should know, how much did Air France spend on fuel, for example. Then they need to use a lot of aircraft. And, well, aircraft leads to depreciation. Therefore, I should know what the depreciation is, and so on. So I want to know what are the salaries, and therefore here you have the salaries. I want to know what depreciation is. Therefore, here you give me depreciation. And I want to know the fuel cost. Thank you, Chang Tran, for this answer. I need the fuel cost. Well, many airlines present the fuel cost as a separate line on the income statement. Here, the fuel cost for Air France is included in external expenses. And I would need to check in the note number 6 to find this out. So in the service industry, I need salaries and items, and therefore I need an income statement by nature. Okay, so service companies usually present an income statement by nature. Manufacturing companies usually present an income statement by function, because you want to know what your production cost is. You want to know what your marketing cost is. So you do all this already for internal purposes, and then you take the same numbers and you just publish them, obviously in an aggregated mode. So that means the choice by nature or by function is mostly industry driven, but not all the time, because here I contradict myself, because Orange is by nature, Vodafone is by function, although both companies are exactly in the same industry. That means outside the industry driver, there's also, we could call it a country driver. Because the income statement by function, as has earlier been mentioned, is actually very typical for UK companies. A lot of UK companies, they always did a presentation by function, and therefore they do it still today. Whereas in France in particular, and in continental Europe, the income statement by nature was much more common in the past. And therefore Orange here continues to use the nature presentation. So we have industry drivers of the choice, but we also have country drivers. No? Okay, so both is relevant. Okay, so IFRS income statement, there's not much required. Many choices here for companies, which line items by nature, by function, and so on. Then secondly, we spoke about the one statement approach or the two statement approach that most companies use. Here we have a two statement approach. And here I gave you an example of a one statement approach. Okay. And with that, basically, we are done regarding the income statement. Any questions on that, please? Well, that doesn't seem the case. And we can continue and look at the third statement that is part of IFRS financial statements, which is the cash flow statement. Okay, so remember yesterday I told you that the income statement, additional income statement, is nothing else than the explanation of this single line in equity that is called profit, but giving me much more details on where the profits come from. Well, the cash flow statement similarly is just an explanation how I got to this final cash number that I see in my balance sheet. So the cash flow statement is a separate table just explaining this cash position here that I have. Okay, so income statement explains the profit position. Cash flow statement explains the cash position that I have at the end of the year. So the cash flow statement is relatively easy to understand because you have cash inflows and therefore you have a plus sign in the cash flow statement, and you have cash outflows where you spend money. So you see that with a negative sign. And also the cash flow statement in IFRS, but also worldwide, is probably the most comparable statement compared to the balance sheet, compared to the income statement, because the presentation is much more standardized. We have seen the balance sheet, there's different ways of doing things. In the income statement, there's different ways of doing things. In the cash flow statement, there are also some differences, but mostly we will find the three categories that you see here in this slide. We have total cash flows are divided in operating cash flows, investing cash flows, and financing cash flows. And here you have the short definition, what we are talking about. So operating cash flow is cash flow from my core business, from operations. So roughly money I received from my clients, okay, cash inflow, and cash outflows because I paid my suppliers. So that difference is operating cash flow. Investing cash flows are all cash flows that relate to non-current assets. So I buy a new machine and I pay cash. That would be an investing cash outflow, minus sign. Okay, I sell a machine and somebody pays me money for this. There would be an investing cash inflow, positive sign, plus. And financing cash flows are all cash in and outflows related to financial debt, okay, and to equity. So financial debt includes bank loans, includes payments on bonds that I have issued, But financial debt, for example, does not include payments on accounts payables, because accounts payables are part of operations. They're not part of financing. So here, financing cash flow, for example, I contract a new bank loan. Therefore, the bank gives me money. That would be a financing cash inflow plus. Or I reimburse a loan. Therefore, I pay money to the bank. That would be a financing cash outflow minus. I pay dividends to my shareholders. That is a cash outflow related to equity. Therefore, minus sign in the financing section. Or I issue new shares and therefore shareholders give me money. That would be a financing cash inflow plus, because I receive money from shareholders. Okay, so operating, investing, financing, cash flows. That's what we do. Okay, let's go back to the first case we did yesterday. Now remember the accounting case we had here, where we prepared the balance sheet and the income statement, but we did not do the third part, prepare the cash flow statement. Okay, let's do this now. And for doing this, well, we look at the solution from yesterday. Okay, here's the solution, and here you have the accounting entries for all the transactions. And we see here our cash position. No? Here we see all the transactions that I had in a cash position. And actually, what I will do is I need to, for the cash flow statement, I need to classify all cash flows in my two sections. What is operating, what is investing, and what is financing cash flow. Okay, that's what I need to do. The cash movements have already been accounted for. So for example, here in transaction number 1, I had a cash movement of plus 120. I received money. And this money is from the shareholders. Now remember, the shareholders provided cash in 120 and an equipment. So here the plus 120 is related to shareholder financing. So does that mean we have here an operating cash flow or investing cash flow or financing cash flow? What do you think? Receiving money from shareholders. Yes, Dongfang, it's a financing cash flow. That means here in the financing section, I would put plus 120, what we are talking about. Very good. In number 5, minus 90, we were talking about paying salaries. The minus 90, number 5. We go back to the income statement. We see here the salary expense. So number 5 was paying salaries. So when I pay salaries, is this an operating cash flow, an investing cash flow, or a financing cash flow? What do you think? Chung Tran, yes, it is an operating cash flow. Okay, so therefore here in the operating section, I would put, minus 90, operating cash outflow. Number 7 here, plus 130, was money I received from clients. You see here my accounts receivables decreased, my cash position increased because my clients paid me 130. This operating, investing, or financing cash flow. What do we have? Yes, indeed, you are right. This is operating cash flow, so plus 130. And then the last cash flow is minus 70. That was related to paying suppliers. So therefore, cash outflow of minus 70. So is this operating, investing, or financing? And indeed, you are right. Here, once again, we are talking about an operating cash flow. So minus 70, minus 70 in the operating section. So it means here I have 4 cash flows. Therefore, in my cash flow statement, I have 4 numbers, and we are done. Okay, so now I can calculate my operating cash flow, and we see that operating cash flow is actually negative. It's minus 30, sorry, minus 30, because operating cash outflows are higher than inflows. Okay, investing cash flow is 0 because we are not doing anything. And financing cash flow is plus 120. Okay, very good. That means now I can calculate my total change or total cash flow. What is that? Well, it's the sum of the 3 parts. Therefore, my total cash flow is plus 90. Now, minus 30 in operations, plus 120 in financing. And then usually this plus 90, I will check it with the numbers that I actually have in the balance sheet. Therefore, I will compare cash flow at the beginning of the year, okay, and cash flow at end of the year. Okay, well, the cash flow at the end of the year is what we have in the balance sheet, and it's shown here. My cash flow at the end of the year is 90, or I should say plus 90. What was my cash situation at the beginning of the year? Can somebody tell me? In other words, before I accounted for the very first transaction here, what was my cash position? What was the amount of my cash position? Anyone? So how much cash did the company own before the first transaction? Sorry, Dongfang, that's not correct. Yes, here we go. Tran, that's right. At the beginning, we had 0 because we are talking about a new company that was created. Okay, so in the balance sheet of last year, well, there is none, but hypothetically, in the balance sheet of last year, I have a cash position of 0. At the end of this year, the cash position is plus 90. So overall, my cash position increased by 90. And that information, actually, I can already see it in the balance sheet. So that's not what I need the cash flow statement for. But now I see how the plus 90 are composed. And I see that in the core business, actually, there was a loss of cash. And my cash position is only positive because the shareholders invested a lot of money in the beginning of the company. But that's normal. In the first year, usually companies do not generate cash. That's why the shareholders need to provide cash in the beginning to get things running. And then over the years, well, one day we will generate our own cash. Okay, that's what we're doing in the cash flow statement. All right. So we categorize that. And here we have as an example the cash flow statement of Schneider Electric, well, a French company that I guess is also active in Vietnam. And we see here the first part is the operating cash flow plus 4 billion. And then on the next page, we have the investing cash flow, which is negative here in brackets. And we have the financing cash flow, which in 2020 was positive. We have the total change in cash, which in 2020 is positive, plus 3 billion. And then here you see how our ending cash position compared to last year, from 3.3 billion, it increases to 7 billion. So we see exactly what I said before. Okay. Now, let's talk about something else, because here you see the operating cash flow. And obviously, it is very important for a company that the operating cash flow is positive. at all times if possible. In our case, number one that we just finished, we saw that operating cash flow is negative, well, because it's a young company. Here, Schneider Electric is a company that exists for many, many decades, and therefore they have a positive operating cash flow. That means basically that your clients pay you more money than you pay to your suppliers. And well, now it makes sense that operating cash flow has to be positive, because if it is negative, that means you receive less money from your clients than you pay to your suppliers. And we easily understand that this is not a sustainable situation, because if you don't get cash from your clients, where do you get it from? And you need to pay suppliers. So that is not a lasting situation. So here we see operating cash flow is positive, and therefore it's normal, it's good. We see that investing cash flow is negative. It's negative in both years. So what do you think? Is a negative investing cash flow, is this bad news for the company, or is it good news? Well, it depends. I like that. That's a very, very much an accounting answer. But Hangwu, it depends on what? Okay, so stage of the company. Well, you need to be more specific then, maybe. Because I'm not sure, it depends on the stage of the company. All companies need to invest. Huh? Well, Chung Tran, I don't know what you mean by that. It depends on the potential for mergers and acquisitions. Obviously, if I buy up other companies, so we see here, for example, acquisition of businesses, that would appear in the investing section. Okay, and we see last year they invested a lot here. This year, the year before less, but it's not the main point. In general, we could say what Kan Tran said, that it's mostly good news. Companies need to invest. In particular, they need to invest in new property, plant, and equipment, because you are a manufacturing company, you are a service company. Therefore, you need to invest in your hard assets that allow you to produce, or that allow you to propose the services. If you stop investing, so let's say investing cash flow 0, if you stop investing, well, no investments today, that means no profits tomorrow. That means no cash inflows, no operating cash inflows tomorrow, or less. Okay, therefore, I would expect investing cash flows always to be negative. It means the company invests. Of course, we need to do an analysis what they are buying, because not any investment as such per se is positive. If they invest in stupid things, they should not do it. But at least if I just look at the total cash flow, if the investing cash flow is negative, that potentially is good news. And then I analyze what they are buying, and then we decide if that makes sense or not. Okay, so operating cash flow positive, investing cash flow negative. Okay. Now, if I compare those two cash flows, I can calculate what is called the free cash flow that some of you may have heard. How do I calculate free cash flow? Well, it's operating cash flow minus investing cash flow. Okay, I put the investing cash flow here in brackets. Why? Well, I will tell you. First of all, the notion of free cash flow is something that is used in financial statement analysis and by people who value companies and so on. It is not defined officially. It's not defined in accounting regulation. It's not defined in IFRS. It's not defined in French GAAP. It's not defined in US GAAP. And I guess it's not defined in Vietnamese GAAP either. It means here we are talking about concepts, same as all ratios, return on equity, debt equity ratio, all those ratios and concepts are not specifically defined. That means there's a variety of ways how to calculate it. So here I wrote free cash flow is operating cash flow minus investing cash flow. That's a short formula. Now, a lot of people don't take the total investing cash flow. They only consider investments in, let's say, property, plant, and equipment, the hard assets, but not financial investments. Okay, so therefore, sometimes you have to be a little bit more specific. Okay, but roughly the idea of free cash flow is operating cash flow minus investing cash flow. So remember, operating cash flow is the money I spend or I generated by doing my operations. So for example, my operating cash flow is plus 5,000. Okay. And the investing cash flow is what I spend on investments. And maybe, let's say, my investing cash flow is minus 3,000. Okay, why not? Okay, that means here in this case, my free cash flow is plus 2,000. Okay, so what does that mean? Okay, well, it means with my core business, producing and selling my products, I generated a cash, not profit. I generated cash of 5,000. So my clients paid me 5,000 more than I needed to pay to my suppliers. And now I take part of those 5,000, actually, I take 3,000 and I spend them on reinvesting in my business. Because mostly I buy PPE. Okay, and that makes a free cash flow that is positive. First of all, a positive free cash flow means, and is a sign of financial independence from outside financing. Here in this situation, I don't need to go to see a bank in order to finance my investments because I can pay them on my own with the money I generate from my own business. Okay? So I don't need the banks. I'm independent from the banks. I don't need to see the shareholders and ask them for money to be able to do my investments. Okay, because my free cash flow is positive. My operating cash flow is higher than what I need for investments. Now be careful. I said I don't need to go see my bank or the shareholders. I don't need to. It doesn't mean I will go see them anyway, because interest rates are very low, for example, right away. But I don't need them, which means obviously I'm in a much better negotiation position. And if I don't like the propositions of banks and shareholders, I don't take their money because I don't need it. Okay, so a positive free cash flow is a sign of independence from outside financing. That's one point. And secondly, it's called the free cash flow. And why do you think it's called free? What is it free for? What is it free from? Why is it called free cash flow? Any idea? What can I or what must I do with the 2,000 that are left over? So I paid all my operations, I paid all my suppliers, I paid all my investments, and after this there's still 2,000 in the bank. But what else do I need to pay? Potentially. That's the free cash flow form. Some people, yes, Hangwu, for example, for shareholders. Cantran, it means available cash we can use. That is true. But what should I use it in priority for? Obviously, that's true. 2,000 are left over. I can use them. So I use them. Remember the cash flow statement. We have the operating cash flow that is covered. We have the investing cash flow that's more or less covered. So what is left over? Well, the financing section, the financing cash flow. That means the free cash flow now is available since it's positive here, to reimburse debt, for example. That's what I do in the financing section. Or to pay dividends to shareholders. That is in the financing section. Okay. That means the free cash flow here can also be used as an indicator of financial risk. Because the higher my free cash flow is, the easier and the more financial debt I can reimburse. Okay, and the more dividends I can pay potentially to my shareholders, which makes the company more attractive for shareholders. Okay, whereas if the free cash flow is negative, for example, can happen in particular when we are making a very important investments. If my free cash flow is negative, that means potentially I need additional financing from the shareholders or from the banks in the financing section. That means the financial risk here will increase. I can reimburse less, I can pay less dividends, and so on. Yes, Chung Tran, you are right. We don't need to borrow much or nothing, basically, from outside lenders. Okay. That's free cash flow. Here we are. Okay, and that's why, remember Air France at the beginning of their document, when they talked about the key figures, they talked about operating cash flow, or what they call adjusted operating free cash flow. So remember, once again, free cash flow is not a defined, a well-defined way. That means in the report of Air France somewhere, they tell us what the definition is, and we need to check what does adjusted operating free cash flow mean. But the underlying idea to you now is clear. And we see also it has been negative in the last 2 years, which is not a good sign for Air France, and it was very low in 2018. So it means basically they have debt issues, they have free cash flow issues, which is not a good sign for their financial health, obviously. Okay, so operating cash flow should be positive all the time. That's what we have here. Investing cash flow is probably negative. Okay, and then we make the comparison operating cash flow, investing cash flow to see the free cash flow. Okay. How about financing cash flows? Here we see in 2020 it was positive, but in 2019 it was negative. So do we have a specific explanation or expectation, sorry, in terms of financing cash flow? Is it good impact or not? Dongfang, I will answer your question a little bit later. So here, financing activities. Should the sign be positive all the times? Should the sign be negative all the times? What is good news? What is bad news? Any ideas regarding the financing cash flow? Well, the answer here is it depends what we had before. Actually, the financing cash flow will react to what's happening in the 2 other categories of cash flow, and that's the job of the finance department. So if, for example, I have a lot of investments and my operating cash flow is not sufficient to cover those investments, well, obviously, I need to raise extra money in the financing section, and therefore my financing cash flow would be positive. If, on the other hand, my free cash flow is very high and I don't need the money, well, I can spend this money in the financing section and my financing cash flow would be negative. And you see here they paid a lot of dividends. They reimbursed a lot of debt last year, okay, because in 2019 that was possible. In 2020, because of COVID, the situation is different, and therefore they raised a lot of new debt. Well, probably partially also to finance the acquisition here. They still continued, however, to pay dividends. They raised a lot of other financial debt and so on. Okay, so for the financing cash flow, we don't have a clear expectation. Can be positive, can be negative. It's not as such good or bad news. You have to see this in line with the operating cash flow in the investing cash flow. And from this, we can have an opinion. Okay, now there was a question from Dongfang. I suppose you are referring here to the effect of discontinued operations. Discontinued, not discounted, discontinued operations. Well, this is something that we see not only in the cash flow statement, but also in other statements. So, for example, if we go back to the income statement here, you see also here we have discontinued operations. We have profits from continuing operations, but we also have profit from discontinued operations, for example. So those discontinued operations is not only in the cash flow statement, it's also something that we have in other statements, also in the balance sheet. So what are we talking here about? Discontinued operations. Well, remember the forecasting function of financial statements. So I look at the past in order to forecast the future. Now, if in 2020 or 19 or whenever, if in 2020 I know, for example, that I will sell part of my activities. You know, I'm operating in many countries, and now for one reason or the other, I want to sell all my activities in Brazil. Okay, well, that means in my balance sheet, in my income statement 2020, and in my cash flow statement 2020, the Brazilian numbers are still incorporated because I did not yet sell those activities. Therefore, the numbers are still incorporated. However, it's a good idea to separate them from the rest because I know that in 21 I will sell all my Brazilian activities, and therefore the Brazilian numbers will not be there anymore in 21. And therefore, to make the forecast easier, I will separate already in 20, I will separate the Brazilian numbers from the rest, because the rest is continuing and my forecast should be based only on those continuing numbers. Everything that is discontinued will disappear in 21, and therefore it's separated. So that means here, okay, for Schneider in 20, that didn't have anything here, so it's 0. But in 19, actually, there were activities that were sold or were destined to be sold, and they had a negative impact on cash. However, this negative impact would disappear and disappeared in 20, and therefore they're not showing this anymore. Same here. If you look at Vodafone, you see here their profit from continuing operations was positive and negative over the last 2 years. Therefore, to restructure, in 2019, they decided to sell part of their activities. And therefore, you see that significantly decreased their loss, and we see that also in the following years, but they separated this number already. So that means, okay, at the end of 2019, when I was doing a forecast, my forecast should be based only on a loss of 4 billion, not based on a loss of 7 billion. Okay, so discontinued operations are operations that soon will disappear from the company, and therefore we highlight this effect separately to improve the forecast quality. All right, that's why we do this. Okay, Dongfang, are we good? And the others? That's it about the cash flow statement. So maybe one last point, because I explained the cash flow statement and we had all this. However, you see that for the operating cash flow only, not for the others, but for the operating cash flow only, there is a choice between the direct method of presenting cash flows or the indirect method. Okay, so the direct method of calculating cash flows is what we did here. You see, I take the cash inflows and cash outflows for operating cash flows, and I present the result. This here basically is the direct method. That's what I did here. Okay, so money from clients minus money to suppliers. However, if I look, if I look at cash flow statement of Schneider, for example, and operating cash flow here, we see they're not saying money from clients minus money to suppliers. Instead, they're using income statement information, you know, profit, net income, depreciation, impairment, losses, and so on. So all this is income statement information. And then they use balance sheet information, you know, changes in accounts receivable, changes in inventory, and so on. Okay. So here, this is a cash flow statement, an operating cash flow that is calculated with the indirect method. Okay. And most companies do use the indirect method. So it's very rare. Actually, in real life, I've never seen it, that a company uses the direct method. All companies use the indirect method to calculate the cash flow. Okay, so what's then the difference between the direct method that we did here and the indirect method? Well, when I do the indirect method, do I do? Well, something that what I want to know, okay, is operating cash inflow minus, minus, minus operating cash outflow. Okay, that's what I want to know. And that equals operating cash flow. I can do this exactly like we did here. That's what I do, plus and minus. But the indirect method, what I will do is I will deduct operating cash flow from net income. So actually, I will start with the accounting profit. And then I will do adjustments. And doing these adjustments will also lead to operating cash flow. That's the idea. So why do I need to do adjustments? Well, because I know that net income, accounting profit, and cash flow is not the same. Net income is based on revenues and expenses. Cash flow is based on cash inflows and outflows, and revenues and expenses are not necessarily equal. Okay, and therefore I do adjustments for non-cash revenues and expenses. That's what I do. Okay, so without going further into details, that's what I see here. Okay, that's what Schneider is doing. Okay, we start with profit. And then primarily I have revenues and expenses with no effect on cash flow. And therefore I adjust. I have also adjustments for working capital changes, but the underlying idea is the same. So for example, if I have a sales revenue that increases my profit, but clients do not pay me, well, that means there is a change in accounts receivable, a change that is not cash. And therefore, I do an adjustment. Okay, so that's the indirect method. I start from net income and then I adjust the net income numbers in order to get to operating cash flow. All right, that's the difference between the direct method and the indirect method. Okay, that applies only for operating cash flow. It's just a difference in method. The final result will be the same. So my operating cash flow here is 4 billion plus 4 billion. All right. And that's direct, indirect method. I don't care. It's 4 billion. Okay. All right. That's it on the cash flow statement. Questions on that? Okay. Not. We continue. We have a third statement. It's called the statement of changes in equity. Okay, so it explains line by line in equity why those items changed. Nowadays, okay, the usefulness of this statement is rather limited, because the most interested things, actually we see them already. So we see already profit or loss in the income statement. We see OCI because I have total comprehensive income. I see in the balance sheet that capital increases and decreases. So the only thing is I have some more details on transactions with owners, but those details I could also find them somewhere else. So we see here for Schneider Electric what's happening. So the structure of the statement of changes in shareholders' equity is always the same. Here in the different columns, we have the different line items of equity. So capital, additional paid-in capital, retained earnings, and so on. And here the different lines are the different transactions that change the numbers. So for example, any profit increases retained earnings. So OCI is negative, therefore decreases retained earnings. So total comprehensive income goes in retained earnings. And when we pay dividends, which we have here, obviously retained profits or retained earnings decrease. So dividend payments is something that I see here. But remember, we have dividend payments already in the cash flow statement. By the way, let's check if we have the same thing. You see here, cash outflow, dividend payments to shareholders, 1.4 billion. Okay, well, it's the same 1.4 billion that I see here. And 112 million dividends paid to non-controlling interest. We see also changes in treasury shares. Does anyone know what treasury shares are? We'll discuss this more in detail a little bit later when we talk about accounting for equity. Treasury shares means the company buys back its own shares on the market. So here, at the end of 2020, Schneider Electric had bought back for 3.3 billion purchase price its own shares on the market, for example. So you see, okay, we have different information, but all of this is already more or less visible in the balance sheet or can be found in the notes already. So the usefulness of this statement is limited. Balance sheet, income statement, cash flow statement, these are the three main statements. Okay, questions to this here, to the statement of changes in shareholders' equity? Okay, that's not the case. Then the last element that we have are the notes to the financial statements. Obviously, the notes are very important. If you look at the financial statements of Air France, if we go back to that and to the structure, you see that the notes actually are the main part. So we have the balance sheet, the income statement, the cash flow statement, and so on. So that's like 5, 6, 7 pages. But then the notes obviously is the main part, because you see here we have basically almost 90 pages of notes. The notes are important. Why? Well, because on the main financial statements, if I look here at the cash flow statement, or if I look at the income statement, obviously here we talk about revenues and expenses on a worldwide basis. So the numbers here in the balance sheet, and the income statement, the cash flow statement are very much aggregated. And therefore, one important function of the nodes is to disaggregate those numbers and to provide some more details that are interesting to know, that are necessary to do forecast. Also in the nodes tell us about accounting choices. So which type of accounting regulation did they use? Did they use IFRS or Vietnamese accounting standards? Sometimes we have accounting choices, or the company has accounting choices. How did they exercise this choice? How did they depreciate? How did they value their inventory, etc., etc. Okay. All this can be found in notes, so it's very important to do to prepare our analysis. And in the notes also we have segment information. So as I said, segment information is very important because we have worldwide numbers, and maybe the activities of the companies are very heterogeneous, and therefore just knowing the sales revenue of a company is not enough. You need to know a little bit more if you want to do a forecast. You need to know in which countries, for example, the group is operating, or you need to know what are the main activities. And therefore, IFRS number 8 requires the disclosure in the notes of segment information. Okay, what is a segment? So how do you know how specific you need to be? Well, they use the management approach for segment. IFRS uses the management approach. That means you should provide externally in your financial statements the same information that the management uses internally. Because when the executive board of the company meets and discusses company matters and to see how activities are doing and so on, obviously they are looking at segment numbers, at detailed numbers. So how do they segment internally the activity? Is it by country? Is it by, I don't know what, by type of product? Is it by business segments? I don't know. And it doesn't matter, whatever you look at internally, well, you present the same thing externally in your financial report. Okay. So you look at all the segments that you have internally, and based on this, you identify the so-called reportable segments. Reportable segments are only important segments. Remember, relevance, only important stuff. What are important segments? Important segments, segments where key numbers are bigger than 10%. You see either revenue or profit or loss or assets. Okay, so internally we have a certain number of segments. Only the big segments are the ones that will be reported on. The smaller segments, I will regroup them and I will call them other. Okay. So now in order to avoid, so basically this rule here is to avoid information overload. I don't want to see like 20 segments. That would be too much. Therefore, with the 10% rule, I narrow this down, and usually, like 10 segments, or most groups actually have much less. A limited number of segments is more useful. Now, in order to avoid that company, avoid the rule here and cut the activity in many, many small segments so that none is above 10%. And then the company would say, oh, I'm sorry, I don't have any important segments, so I'm not giving you any segment information at all. There's a second rule. It's the 75% rule. So you need to identify enough segments, big ones, and if not smaller ones, you need to identify enough segments so that the numbers that you present, the segments that you present, make up at least 75% of the sales revenue of the company. So it means the segment information needs to provide at least information that covers 75% of the activity of the group. Okay, that applies even if no segment meets the 10% test. Then I need to take smaller segments and present them individually. Okay, so 10% segment, 10% test to identify the big segments, then the big segments need to be presented. If they cover more than 75% of the revenue, we are good. If they don't cover 75%, I need to identify additional smaller segments in order to get up to the 75%. Okay, in order to finish, let's see here for Lufthansa, so a German airline company, what the segment reporting is. And the segment reporting also is rather standardized. In the different columns, you have the different segments. So here Lufthansa operates in 5 different activities, and the different lines is the segment information. Actually, here the segment information goes over 2 pages for Lufthansa, or one big page. Well, you could expect that the management board, when they meet every week, they will have a look at the same page. Okay. And you see it's rather detailed. You have a lot of income statement information, but there's also information on capital employed. There's information on spending, capital expenditures or investments in the different segments. And that gives you a rather good visibility. So here, for example, the 5 segments, we have Network Airlines, we have Eurowings, which is another airline, but this one is low cost. Eurowings is a low cost airline. The network airlines here are what we call legacy carriers. And actually the business model here is very different. Therefore, it's 2 different segments. Logistics is a different segment. MRO is maintenance, different segment. Catering, a different segment. So therefore, it's rather important to know all this. Obviously, we see that in the total revenue of the Lufthansa Group, legacy network airlines are almost 50%. Well, that's by far the most important, and this is COVID related. In normal years, it's actually even higher than that, which makes sense. And those different segments, since we talk about forecast, they react very differently. So, for example, in the airline business, except COVID, obviously, that's something you cannot forecast. But except COVID, airline business is rather stable. So it's very rare, once again, COVID. Other than that, it's very rare to have big changes. Logistics, on the other hand, is a business that is very volatile. So at least when in China or in Vietnam, the activity goes down, logistics business goes down immediately. At least as the activity picks up, logistics revenue picks up very quickly. So here you see how important this is for forecasting, because we are not in the same markets, and therefore we need to know this. Lufthansa also provides some additional information related to countries. Okay, for airlines, obviously that's not so important, because any aircraft can fly from A to B, and I don't care where the aircraft is. I need connections, and that's something I don't see in the segment revenue. That's something that Lufthansa will tell me outside of the report. They will tell me we started new flights to Vietnam, and therefore we generate additional revenues with Vietnam, for example. Okay. Unless you still have questions, we are done for the day. Do you have any final questions here on the segment reporting, statement of shareholders' equity, or anything else? Well, apparently not. That means we are done for the day. And I wish you a pleasant evening, and I talk to you tomorrow. Okay. Thank you very much, and bye-bye.